Everyone, in this video, we are going to learn how to build net worth with disciplined equity investing. In this video, we will empower the retail investors with strategies wherein they can track, select, and manage investment for sustainable, earning driven wealth. Now, our ultimate objective is to make wealth for our customers, for our subscribers. And that is why we are going to understand how, by tracking your net worth, by focusing on selecting stock based on earning per share, and following a 3 into 3 matrix, discipline and research, we are going to build the wealth. So let's first talk about how to build net worth strategically. Well, first, you need to regularly monitor your assets using reliable portfolio tracking apps so as to maintain up-to-date view of your financial standing. This will help you to make informed decisions. You can calculate your net worth by combining all the assets that you owe in equities, how much you have in your retirement fund, how much saving you have, retail stake. To access your total net worth, you need to have a safety cushion. For example, in assets like debt, gold, stocks, fixed deposits, land, to protect against any downside risk before increasing equity exposure. Also, you need to have monthly reviews to categorize assets into equity and non-equity buckets. This will help you to allocate and align with your financial goals and risk appetite. Now, once we talk about building wealth, one of the easiest and the most prominent ways is to select stocks and have a portfolio wherein you have good quality, high earning per share focused stocks. So here we are going to target stocks based on earning per share. So you need to target stocks with 15 to 20% annual EPS growth. This you can do with the help of any tracker. Now, what happens once you choose stocks based on EPS growth of 15 to 20%? These companies will be strong, sustainable, and their earnings will continuously increase. Also, you need to evaluate the price to earning ratio carefully so that the valuation of the stock is reasonable. You are not buying a particular stock at a very high price, because then your possibility of making good profits will reduce. Also, you need to analyze companies' core operations for long-term competitive advantage and to have a perspective. Review promoters and management quality because it's the people who are going to manage the company. So ensure they are credible and the leadership is strong. Select 2 to 3 matrix for screening. The screening can happen on any of the trackers which are available online. You can build screeners available through different websites and can filter the stocks based on EPS, PE ratio, and management as well. Conduct deep dive and search for good quality 3 to 5 promising stocks. Read their financial, compare their competitors, and assess the gray box factor. What are the things that could go bad? Also, once you evaluate the gray box factors like management credibility, you need to also understand what is it that is going to bring and make this company stand in front of its competitors. So once you have it, you will do the investment. Now let me talk about a 3 into 3 matrix, which will help you to systematically allocate your capital into different framework. Large cap, mid cap, small cap. Large cap companies are the big companies wherein all the major market is dependent upon. Mid cap companies are the smaller companies wherein they are below the market capitalization of large cap. In small caps are new upcoming entrepreneurs and good small companies who have the potential to grow big in future. So once you're able to assess and analyze large cap, mid cap, and small cap stocks and companies, you will be able to make a good portfolio. Another way to maximize your wealth in the longer period of time is to have SIP discipline. Systematic investment plan for 15 to 20 years will show you historical and commendable compounding interest. Start early, begin SIP investment, even with the modest amount of rupees 500, as early as possible. The younger you are, the better it is. With an annual increase of 10 to 15%, which is now called a step up SIP, you'll be able to increase the contribution every year automatically. Try to automate your investments through SIPs, do annual reviews, and ensure that your SIP discipline does not fluctuate with the market. No matter how much market falls or goes up, your SIPs will continue. Also, diversify your investment and have balanced risk. Try to have global exposure through international indices like NASDAQ 100 for diversified global growth potential. Allocate gold exposure so that you have physical holdings wherein you can not only sell gold when it's in requirement, but also a good way to hedge any risk in the future. Include real estate or land assets. You need to have sufficient cash reserves, leverage screening and research tools for better investment. Use free tools like Screener to filter and track stocks. Read detailed research reports from credible agencies. Follow niche experts on Twitter, Telegram, and Instagram, and Substack as well. Utilize credit rating rationales, save and maintain custom screens, and dedicate 30 minutes weekly to read and report one stock for continuous learning. This is how you will eventually enhance your learning and build a portfolio wherein your investment will grow and make you wealthy. So long-term EPS aligned investment strategy, we have already talked about it. You need to have multi-bagger stocks, volatility tolerance, and with long-term horizon of 10 to 20 years. Once you have all this, you will be able to make wealth for yourself. This is a brief